Good day, I'm Chartered, your accounting tutor. In today's video and class, we are going to continue. Mind you, we are treating end of accounting period adjustments. And I promise you that we are going to be taking them one after another, how they are being adjusted in the financial statement. Number one of the adjustment is what is called the closing inventory, that is unsold goods at the end of an accounting period. How do you handle closing inventory in the financial statement? It is clear, if you can see, closing inventory are deducted from the cost of goods available for sale to arrive at what is called the cost of goods sold or cost of sales under trading account. It is important that this closing inventory is not found in the trial balance because they are unsold goods, but the opening inventory is found in the trial balance. Therefore, if you discover that closing inventory is found in the additional information, it is for you to treat it in the trading account. The second one is closing inventory is used under current assets in the statement of financial position. Under current assets, one of the first current assets in statement of financial position is closing inventory. Then, this adjustment we have to understand. Sometimes the closing inventory that is already determined might be lost or damaged. So if the value of the closing inventory reported by the question that the values that is already determined that's supposed to be used in the financial position have been lost, or anything that have happened to it to reduce its value, what you do is that you have to adjust by reducing the value of the closing inventory to arrive at the value that is already that will be available on ground. Then such will be deducted from the closing inventory value that is already given as an adjustment before the loss occur, before using it, mind you. And such losses, the loss in the amount of closing inventory, the amount that has been lost, mind you, must be treated as an operating expenses. Mind you, in adjustment, what happened in the profit and loss account must somehow have an effect in the financial position, otherwise the account will not balance, or must have a two effect, whereby one affect trading, one affect profit or what? Loss. So if there's a reduction in the closing value, by the time you reduce the closing value, you must also show the effect because it becomes an operating expenses in the profit or loss account. Let's quickly look at an illustration and how we are going to show it in what is called an extract of the financial position. So let's look at this illustration whereby, given a trial balance, in additional information, there was inventory as at 31st December 2025, which valued at 50,000. Inventory at the end of the year, 31st of December 2025, value 50,000. Let us see how we are going to present it in the trading account via what is called an extract. It's just trading account extract. Extract means it's not the full trading account. It's just the area that we are concerned that we are treating here. So if you are preparing your trading account, you come to a point where you have what is called cost of goods available for what? Sale, or cost of goods for sale. Here is an assumption. Let's assume that the cost of goods available for sale after preparing the other items as I showed in my previous class, how the format is being followed, you arrive at a cost of goods available for sale that was 250,000. Here comes the adjustment. Look at the adjustment of closing inventory we're talking about. The value that is given as closing inventory, this is the time to adjust it. What you are deducting here is an adjustment, whereby the cost of goods available for sale is 250,000. You have to adjust by deducting the value of closing inventory, which is 50,000, given in the information, to arrive at what is called cost of goods sold or cost of sales. So if you mind I told you that anything in bracket means deduction. If you deduct 50,000 from 250,000, you got 200,000, which is the cost of goods sold or what is called cost of sales. This is what is called an adjustment. So don't forget that you have to deduct closing inventory from cost of goods available for sale to get what is called cost of sales. This is all about how you treat it in the trading account. But mind you, if there's a loss, this 50,000, if there's a loss in inventory that are already determined, the amount of 50,000 will be deducted. Inside the 50,000, for example, if there's a loss of let's say 10,000 from the already determined 50,000 closing value, you have to now say 50,000 minus 20,000 will give you 30,000. So instead of using the 50,000 or you are going to use 30,000 as the closing inventory. Then by the time you come to what is called profit or loss, the 30,000, the 20,000 loss will be treated as an operating expenses. Though it is not calculated, I'm explaining in case whereby the closing inventory is given and loss in the inventory is also reported, which means it will reduce the value of the closing inventory. So such value should be deducted to get the actual closing inventory, which should be deducted, and the loss value, which is 20,000 for instance, should be used under profit or loss as an operating expenses. Mind you, I'm saying emphasize it. But if there's no loss, the whole amount should be treated and deducted to get cost of goods, sold. Let's go to the next statement, which is statement of financial position. How do you use closing inventory adjustment? Here you are only just taking the value of closing inventory and using it as a current asset. You have nothing to adjust, you can use it as a current asset. So you are using the value here as a current asset together with the other current assets that the question will report. And mind you, as already said, that if there's a loss, it is the value that is lost that should be used, that should be used here. For example, if there's loss of 20,000, the remaining 30,000 is what should be captured here, but not all the total 50,000. Let us look how it is being generalized. Mind you, I told you that all adjustment must be generalized. If there's an adjustment I did not capture it in the journal, it means it cannot be part of the double entry. And adjustment means these are things that were not done in the double entry, which is the day-to-day posting of the business, and were balanced and transferred to trial balance. So bringing the journal entry means you are trying to recapture the item that was not captured so that it will become part of the double entry. Then by the time we prepare what is called the adjusted trial balance, all the elements will be found in the adjusted trial balance to use to prepare the new statement, which will have no adjustment. So if you want to prepare the journal entry to incorporate it into ledger, you now come and then debit inventory. Mind the inventory is an asset. So all assets are debited. So in this case, the value of inventory will be debited in the trial balance, and then in the journal entry. Then the opposite will be found in the trading account because the closing inventory is being used in trading account. So by the time you debit inventory and credit trading account in the journal, you have captured the inventory that was not captured in the double entry. Then here in journal you must narrate what happened. So you now say, being to record the unsold inventory at the end of the accounting period. You are trying to capture the unsold inventory back into the ledger or the journal entry so that it will reflect in the new adjusted trial balance. So this is how you handle it in the journal. And this is the area that most learners don't even know at all. Because if adjustments are done and they are not being generalized to bring it back into ledger, here preparing a new adjusted trial balance, it means you have not captured it at all. You must show it out there reflected in the book before you do the adjustment in the final financial position. Mind you, don't forget to like my video, share or comment, because these are areas whereby most learners find it difficult to understand. So if you are able to get the knowledge, make sure you share to another person to be able to comprehend, so that knowledge will continue to grow and your accounting tutor chartered. Like my video, comment and share so that knowledge will grow, and a lot of learners will have no issue in writing examinations or anywhere that they happen to find themselves to explain accounting, they have no issue. Thank you and remain chartered.